Studies show that the pain of losing money is psychologically about twice as powerful as the pleasure of gaining money. Let's say you're 30 years old and you want to start investing $300 a month. If you wait just 5 years because you're still quote unquote figuring it out, that 5-year delay costs you over $100,000. You're listening to Everyone's Talking Money, the show that's all about making life richer. Whether you're here to crush debt, build wealth, or finally feel in control of your cash, you are in the right place. If the word investing makes your palms sweat, you are not alone. This is where most people freeze up. But I want you to stay right here with me because I promise this episode isn't about confusing charts or Wall Street jargon. Hey friend, welcome back to Everyone's Talking Money. Shari here, and if you've been following along with my Financial Confidence Bootcamp series, can we just take a second and acknowledge how far you've come? You've shown up, you've done the work, you've faced your money habits, your fears, and maybe even that voice that says, I'll figure it out someday. But guess what? Someday is today. Let's do a quick recap before we jump in. Episode number 1 of this 4-part series, we said, let's create a budgeting plan that actually works. We're going to stop treating our budget like a punishment, and instead, it's time to make it your permission slip to spend on what really matters. In episode 2, we talked about how to tackle debt without cutting coffee, joy, or your sanity. Debt doesn't have to mean deprivation, and we talked about ways of how to pay it off and still live your life. And then last week's episode 3, we are talking about automation, saving like we mean it. We need to recognize automation builds financial confidence and to stop relying on our willpower and start saving smarter. So if you haven't caught those episodes, pause right here, go back and take a listen. I'm confident you're going to love them. So now it's time for the grand finale, investing. Investing is where you finally step into ownership. This is where your money stops just sitting there and starts growing quietly, powerfully, and without you having to turn into a spreadsheet-obsessed finance bro. Because you know how we feel about those finance bros. So let's take a deep breath. Investing does not have to be scary, complicated, or reserved for people who read the Wall Street Journal for fun. Let's break it down step by step and make it feel human again. Let's get into it. All right, let's start with the uncomfortable truth. Most of us overcomplicate investing. And I don't mean that in a judgmental way. I mean it in a our brains are literally wired to do this to us kind of way. There are 3 major mindset blocks that keep people stuck in analysis paralysis and never actually putting their money to work. And once you can name these blocks, they lose their power. Recognition or acknowledgement is 50% of the journey. The first block, fear of loss. This one's huge. We've all heard the horror stories, right? Someone's uncle who lost everything in the dot-com bubble. A friend's parents who saw their retirement fund cut in half during the 2008 financial crisis. These stories stick with us because our brains are hardwired to remember negative outcomes more vividly than positive ones. And there's actually a term for this in behavioral economics, loss aversion. Studies show that the pain of losing money is psychologically about twice as powerful as the pleasure of gaining money. So when you think about investing, your brain immediately jumps to, but what if I lose it all? Even though the historical data shows that diversified long-term investing, aka the least exciting, the least sexy form of investing, has consistently grown wealth over time. But here's what I want you to understand. The fear is real, but the risk you're actually avoiding by not investing might be greater than the risk you're afraid of. Because when you keep all your money in a savings account earning 0.5% interest while inflation is running at 3% plus, you're not preserving your wealth. You're actively losing purchasing power every single year. So what's the second block? Lack of confidence. This is the one that keeps most people stuck the longest. It's that voice in your head that says, I don't know enough yet. I need to read like 5 more books, maybe take a course, understand every possible scenario and investment option before I even start. And look, education is great. I'm all about it. That's why we do what we do here, why I'm speaking and why you're listening to me right now. But here's the trap. There will always be more to learn. The financial markets are complex systems with thousands of moving parts. You could study for years and still not know everything because even the experts don't know everything. That's why they get it wrong. The confidence you're looking for doesn't come from knowing everything. It comes from knowing enough to take the first step and then learn as you go. It comes from understanding the basics and trusting that the basics actually work. You don't need to be able to read a balance sheet or predict market movements. You just need to understand some fundamental principles and have a plan. Now, reflect on this for a second. Have you been delaying investing because you feel like you should know more, or do you feel like you should know everything? If your answer is the latter, it's never going to happen. We can always learn more, but we're never going to know everything. And the third block, analysis paralysis. This one gets everybody. It's when you get so caught up in trying to make the perfect decision that you end up making no decision at all. Should you invest in index funds or individual stocks? Should you max out your 401k or your Roth IRA first? Should you wait for the market to dip or invest now? What about real estate? What about crypto? What if you pick the wrong thing? Here's what happens. You start researching. You find one article that says one thing and then another article that completely contradicts it. You join online forums where people are arguing about strategy. You listen to podcasts where different experts have different opinions. And suddenly, what should be a straightforward decision becomes this massive, overwhelming project. So you freeze, you wait, you tell yourself you're being smart and cautious, but really, let's be honest, you're just stuck. And here's the thing about waiting. It has a cost. Let's say you're 30 years old and you want to start investing $300 a month. If you start today and average a 7% annual return by the time you're 60, you'll have about $340,000. But if you wait just 5 years because you're still quote unquote figuring it out, you'll end up with about $235,000. That 5-year delay costs you over $100,000. How's that for just being cautious? Time is your single greatest advantage when it comes to investing. And analysis paralysis is literally eating away at that advantage while you're trying to make the perfect choice. So let me give you the reassurance you need to hear. You don't need to time the market. You just need to be in it. You don't need to invest at the perfect moment. You don't need to pick the absolute best performing funds. You don't need to have everything figured out before you start. You just need to start with something, with the basics, and then let time and compound growth do the heavy lifting. Because here is the beautiful secret about investing. It rewards consistency and patience way more than it rewards cleverness and timing. The person who starts early with a simple strategy and sticks with it will almost always outperform the person who waits for the perfect moment and tries to optimize everything. Okay, so we're going to take a quick ad break, but what I want you to do is think. Did those 3 blocks resonate with you? Odds are at least one of them did. And odds are also you know someone who is quietly suffering from these blocks as well. So do us all a favor and share this episode with at least one person who needs to hear it. You and they will not regret it. Okay, so we've talked about what holds us back. Now let's talk about what moves us forward. I'm going to give you a 3-step framework that will take you from I have no idea what I'm doing to I'm an investor faster than you think. This isn't about getting rich quick. This isn't about beating the market or finding some secret strategy. This is about building a foundation that will serve you for the rest of your life. Are you ready? Here we go. Step 1, learn the basics. Not everything, the basics. First, you need to understand your investing vehicles. Think of these as different types of containers for your money. Each one has different rules, different tax advantages, and different purposes. So let's start with the 401k. This is an employer-sponsored retirement account. If you work for a nonprofit organization, like a hospital or a university, you probably have a 403b. Similar rules apply as a 401k. So if your company offers one of these, a 401k, 403b, this should probably be your first stop when it comes to investing, especially if they offer a company match. And here's why. A company match is literally free money. If your employer says they'll match 50% of your contributions up to 6% of your salary, and you're not taking advantage of that, you're turning down a guaranteed 50% return on that portion of your money. There's no investment strategy on earth that can reliably give you that kind of return. So step one within step one. If your employer offers a 401k match, contribute at least enough to get the full match. That's your baseline. The money you put into a traditional 401k or 403b goes in pre-tax, meaning you have not yet paid taxes on that money. And in turn, that lowers your taxable income now. So you tell Uncle Sam you're actually making less money than what you are. And it grows tax deferred, meaning you do not pay taxes on that money until you retire. When you eventually start withdrawing it in retirement, you'll then pay taxes on that withdrawn amount. The idea is that you'll be in a lower tax bracket when you retire. Is that the case? Maybe, maybe not. But a lot of people take advantage of the 401k or 403b for two reasons. One, the employer match, and two, the reduction of taxable income today. Next up, the Roth IRA. This is an individual retirement account that you open up on your own, not through your employer. The key difference, you contribute money that's already been taxed, meaning it's already in your checking account. We've paid our taxes on it. And then once you contribute it to the Roth IRA, it grows completely tax-free. And when you withdraw it in retirement, you don't pay taxes on that money, with the caveat of assuming you're following all the rules that Roth IRAs have. For younger investors, the Roth IRA is gold because you're likely in a lower tax bracket now than when you will be later on in your career. So pay the taxes now while they're relatively low and enjoy tax-free growth and withdrawals forever. Even if you're in a pretty high tax bracket right now, the Roth IRA is still powerful because that means you're never paying taxes in retirement. So the $3,000 you put into your Roth IRA grows to a number much bigger than $3,000 when you're in retirement and you're never paying taxes on that money. So even if you're in a higher tax bracket today, don't worry about it because you're still going to have compound growth tax-free for decades. Roth IRA is a fantastic tool. There are income limits for Roth IRAs and contribution limits too. For 2025, you can contribute up to $7,000 a year if you're under 50. But even if you can't do the full $7,000, contribute something. Something is better than nothing, especially tax-free somethings. And then there's the taxable brokerage account. This is just a regular investment account with no special tax advantages, but it offers way more flexibility. Your 401k or 403b, your Roth IRA, that's for your future self, like retirement future self. Your taxable brokerage account is for future self, like the short or intermediate term future self, or even retirement future self. That's the flexibility. You're not restricted by contribution limits or retirement age rules. You can put as much in as you want and take out whenever you need it. So this is great for goals that aren't retirement related, like maybe you're saving for a down payment for a house or building wealth you might want to access in 10 or 15 years, or again, just creating that flexibility. Flexibility is what you get with a brokerage account also known as an after-tax account, an individual TOD account, transfer on death. There's a lot of different names, but just know that they're all after-tax accounts and they all provide you that flexibility of accessing it whenever you want, contributing however much you want to it. So those are your three main vehicles. Again, your 401k or 403b, your Roth IRA, or your after-tax brokerage account. And here's kind of the rule, the order of operations when it comes to contributing. Contribute to your 401k up to the company match. Max out your Roth IRA if you're eligible. Then consider a taxable brokerage account. And remember, these are guidelines, not rigid rules. Your situation might be different, and that's okay. Start 3, 2, 1. Step 2, start small and automate. Here's where people mess up. They think they need to have thousands of dollars saved up before they can start investing. Or they wait until they quote unquote have the money. Or they try to time it perfectly. Stop doing all of that. Start where you are and with what you have. If you can only invest $50 a month, invest $50 a month. If you can do $100, do $100. If you can do $500, amazing. The amount matters way less than the habit. Go back to our previous episodes in Bootcamp, all about automation. Here's what you're really building: investor identity. You're training your brain to see yourself as someone who invests. You're establishing the pattern. You're learning how it feels to see your money go into investments instead of just sitting and checking. And this is where automation becomes your secret weapon. Set up automatic contributions from your paycheck or checking account. Make it happen before you even see the money. Because if you wait until the end of the month to invest whatever's left over, there will never be anything left over. Trust me. We are creative creatures. We will find a way to spend what's in front of us. But when it's automated, it's invisible. It's gone before you can even spend it. And you know what? You adjust. Your lifestyle adapts to the income you actually see, and your investments grow in the background without requiring any willpower or discipline or memory. I automate my investments, and now I forget about them most of the time. It just happens. And that's exactly the point. Investing should be boring. It should be automatic. It should fade into the background of your life while it quietly builds your future. Start small if you need to, but start small and automate it. Step 3, diversify and chill. Now, let's talk about what you actually invest in. And I'm going to make this really simple because this is where people get tangled up in complexity. For most people, the answer is low-cost index funds. An index fund is a type of mutual fund or exchange-traded fund that tracks an index, like the S&P 500. So if you were to ever tune into the talking heads on CNBC, you would see the red and green that I talk about, the arrows, the ups and downs, but you would see one thing called the S&P 500. The S&P 500 represents 500 of the largest US companies. Instead of trying to pick individual winning stocks, because honestly, who has the time or energy, you're essentially buying a tiny piece of the entire market. Why are index funds brilliant and like a no-brainer, and talk about diversify and chill? Because it gives you instant diversification. Like, it is the least sexy way to invest. And remember, the less sexy the investing is, the better off we are. You're not betting on Apple or Microsoft or Tesla. You're betting on the entire economy. And historically, over long periods of time, the economy grows. Now, does the market go up every single year? Nope, not at all. There are definitely bad years. There are crashes. There are recessions. But if you zoom out, you look at the trends, the trend is unmistakably upward. Since 1928, the S&P 500 has averaged about 10% annual returns. Some years it's up 30%. Some years it's down 20%. But the long-term average is solidly positive. So here's what a simple, solid portfolio may look like. A total US stock market index fund, maybe a total international stock market fund, and then maybe a bond index for stability. That's it. 3 funds. It's not fancy. Now, should you ever invest in individual stocks? Maybe. If you want to and you understand the risk and you're willing to do some research and you're willing to potentially lose some money over periods of time. But for your core retirement savings, just look to the index funds. Why make it harder than what it needs to be? And then this is the crucial part. Chill. Don't constantly check your balance. Don't panic when the market drops. Don't try to sell high and buy low. Just let it sit. Let compound interest work. Let time do what time does. Because here's what investing really connects to: freedom. It's not just about the returns or the numbers in your account. It's about creating options for yourself. It's about not being stuck in a job you hate because you can't afford to leave. It's about being able to retire while you're still healthy enough to enjoy it. It's about reducing stress and increasing peace of mind. Every dollar you invest today is a piece of future freedom. It's a vote of confidence in your future self. It's you saying, I matter enough to take care of this. And that's worth more than any return percentage. Okay, so let's get real about something. Investing is an emotional roller coaster, and nobody prepares you for that part. You can understand the strategy intellectually, you can have a perfect plan. But the first time you see your account balance drop by $5,000 in a single day, I'm confident your stomach's going to drop too. It's okay, it's just human nature. The market goes through cycles. There are bull markets where everything's going up and everyone thinks they're an investing genius. And then there are bear markets where everything's tanking and everyone's convinced the sky is falling. And when you're in a downturn, when you're watching your hard-earned money seemingly just like evaporate, poof into thin air, your brain is going to scream at you to do something. It's going to tell you to sell. It's going to tell you to get out. It's going to tell you to protect what you have left. And that is where most people blow it. They panic sell at the bottom. And what that does is it locks in their losses. It guarantees, yeah, that $5,000, you did lose it. And then they sit on the sidelines in cash, too scared to get back in, and they miss the recovery. So they lose money on the way down and they miss gains on the way up. Here's what you need to internalize. Market drops are not emergencies unless you make them emergencies. If you're investing for retirement and you're 30 years old, a market crash is not a crisis, it's a sale. Everything just got a lot cheaper. Your automatic contributions are now buying more shares for the same amount of money. That's good news, not bad news. The only way a market drop becomes a permanent loss is if you sell. If you hold on, if you keep contributing, if you wait for the recovery, and there has always been a recovery, then those temporary losses disappear. Let me give you a real example. In March 2020, when the pandemic hit, the market dropped about 34% in a matter of weeks. It was terrifying. People who had $10,000 in their accounts suddenly had, 3, 2, 1. People who had $100,000 in their accounts suddenly had 66,000. And a lot of people sold in panic. You can understand why, right? I just lost $40,000. I'm not going to lose any more. I'm getting out. I'm cutting my losses. But then you know what happened? It fully recovered by August of that same year. So by August of 2020, just a few months later, we were back to where we were. And by the end of 2020, it was higher than it had been before the crash. The people who stayed invested not only recovered their losses, they actually made money. The people who sold, they guaranteed their losses were locked in, and many never got back in. This is why I need you to develop what I call investor identity. Investor identity means you know who you are as an investor. You know your risk tolerance. You know your timeline. You know your strategy. And most importantly, you've decided in advance how you'll react when things get scary. If you wait until you're in the middle of a crisis to figure out your plan, you'll make emotional decisions. But if you've already decided, I'm a long-term investor. I'm invested in a diversified index fund portfolio, and I will not sell during downturns, then when that crisis comes, you already know what to do. Nothing. You do nothing. And doing nothing is really, really hard. Our brains hate inaction. We feel like we should be doing something, fixing something, protecting ourselves. But in investing, doing nothing is often the smartest move. So now let's talk about the other emotional trap, chasing trends. Every few years, there's some investment that's absolutely exploding. In the late 90s, it was tech stocks. In the mid 2000s, it was real estate. A few years ago, it was Bitcoin and crypto. Recently, it's been AI stocks and meme stocks. And when you see people making huge returns, when you see headlines about someone turning $10,000 into $100,000, it's tempting. It's really tempting. You start thinking, why am I sitting here with my boring index funds earning 10% when I could be making life-changing money? But here's the truth. For every person who's made a fortune on the hot trend, there are dozens who lost money. The stories you hear are the success stories. You don't hear about the thousands of people who bought at the peak and watched it crash. Trends are, by definition, late to the party. By the time you're hearing about something as a can't miss opportunity, the earlier adopters have already made their money. You're buying high and you'll probably end up selling low when the trend reverses. Now, I'm not saying you can't invest in individual opportunities. If you want to take 5 to 10% of your portfolio, make speculative bets, go for it. But your core money, that should be in boring, diversified long-term investments. The investors who win are the ones who stay the course. They're the ones who set up their automated contributions and mostly forgot about them. They're the ones who check their balances maybe once a quarter instead of once a day. And they have fun at it because they're like, oh my gosh, look at all the money I've accumulated and I've completely forgotten about this. They're the ones who don't panic when things drop and get greedy when things soar. They're consistent, they're patient, they're boring, and boring wins. So figure out what kind of investor you are. If you're someone who's going to lose sleep over market volatility, maybe you need some more bonds in your portfolio for stability. If you're young and can stomach ups and downs, then maybe you're better off being more aggressive with more stocks. But once you figure it out, stick with it. Trust your plan, trust your process, and stay the course. All right, my friend, that's it. You've made it. This is the end of our 4-part Financial Confidence Bootcamp. And I hope you're taking a minute to actually feel how far you've come. Because these past few weeks weren't just about learning a bunch of money tips. They were about building something deeper, trust in yourself. We started this bootcamp by talking about what financial confidence really is. That it's not about having everything figured out, it's about taking action even when you don't. Then we moved into saving. Not saving for emergencies, but saving for opportunity. You built systems that make your money work for you in real life, not some Pinterest perfect version of it. And today, you stepped into ownership. Learning that investing isn't reserved for people in suits or spreadsheets. It's for anyone ready to let their money grow quietly in the background while they live their damn life. That's a big deal. You've built a foundation most people spend years avoiding. So if no one's told you this lately, I'm proud of you. And here's what I want you to remember moving forward. This is not the finish line. This is the starting point for your next chapter. The chapter where you stop saying, someday I'll figure out my finances, and start saying, I already am. Because confidence doesn't come from knowing everything. It comes from taking that next small step over and over until one day you look around and realize you've built something solid. If you've been loving this series, don't end it here. Make sure you're subscribed to my Talking Points newsletter. That's where I share weekly insights, mindset shifts, and tools to help you keep this momentum going. You can subscribe at everyone'stalkingmoneypodcast.com. This series might be wrapping, but your growth, that's just getting started. Thank you so much for being here, for listening, for doing the work, and for trusting me to walk alongside you. Until next time, remember, you're not waiting for confidence anymore. You're building it, you're living it, and you're investing in it. Literally. I'll see you next time.